the 30th anniversary celebration of the Afreximbank.
Mahesh, I want to bring you in, and please take into account what the rest of your panelists have said. Add your voice, sir, and then Nikita, I'm coming to you. And then, gentlemen, we're going to jump around the panel, so don't expect me to go in the same order again for the next theme. Mahesh.
Thank you very much. I'm very pleased to be here at the invitation of Dr. Orama. I thank you for that, and I also congratulate you on the 30th birthday, as well as on getting an upgrade. It should have been an upgrade to single A. It was an upgrade to triple B. We hope that you get to a single A someday soon. So congratulations. The speakers before have said a lot of different things, and I want to pick up on a couple of threads there to talk about risk. Portfolio investors are typically short-term investors. So they react to short-term market conditions. Long-term investors are really what you want from abroad. Foreign direct investment is really what you want. And for that, you need to have proper bankability of projects, and you need to have proper risk mitigations to cover real risks and perceived risks, both. Real risks are difficult to really change. They take time. Nigeria, for example, where President Obasanjo was here yesterday, I don't know if he's still here, but Tinubu is doing a great job of trying to fix the real issues in Nigeria. Other countries have done many policy reforms. Nigeria has embarked on a major change with the elimination of subsidies and the floating of the exchange rate, and more to come. So those real changes have to make a difference, and they did make a difference in the spreads almost immediately, although that has to be sustained over time. Then there's the issue of perceived risks, and there's a lot of discussion on perceptions of risk. The rating agencies are blamed for much of that, and the investors are blamed for that. And I think that there is a very interesting question that can be raised as to how do you address both real risk and perceived risk. Perceived risk, I thought, should be addressed 20 years ago when I was at the Council on Foreign Relations with the assignment of ratings. So I was involved in the first set of ratings that were funded by the US government and by the UNDP, and 20 years later, we have a $300 billion market for African sovereign bonds, which would not have existed without those sovereign ratings. So let's not forget, when we bashed the rating agencies, those ratings made it possible to get those bond issues done. Now,
Mahesh, we're going to drill down into the risk premium in the next round. Nikita.
Thank you very much. First of all, happy anniversary, and thank you for inviting us here, and thank you for making this event, which is really a central point of every community of bankers, corporates coming here. I may sound not that orthodox as previous speakers, but I think we need to stop thinking in dollar terms. We already settling in multiple currencies. We go into CNY, we go into dirhams, we go into rupees, which means we need to start borrowing in these currencies. And the pockets of liquidity are there. We just need to focus on that, make the right road shows to these markets, and start getting this funding available. That's one point. The second point, the classical model of safekeeping, and I want to echo to what the colleague from African Development Bank said. Africans should learn from Russian experience. We did the same thing. We were keeping our funds at the US European banks at 0%, and we're borrowing at single or double digit. It's no longer available. We need to employ the local capital into the local market without the going into intermediaries and perceived safeness of this money being kept with the international banks or others. If we do that, it means we not only save on the costs, but we also deploy the capital where it is generated. And the Africans have a lot of capital inside and outside the countries. So if we do that, it will bring enormous amount of new funding to the local market.
Thank you very much. So we have 34 minutes left, and we're going to distribute that equitably across our panelists. So you have just over 3 minutes each. And instead of following those three themes, because I know that we're not going to make 2 sessions across the panel again, I'm going to defer to each panelist where they can take their 3 minutes. They can look at the themes at hand: risk in terms of Africa, perception versus reality. And then I want to include the third theme that I'd spoken to you about today, which is innovative instruments and guarantees. So gentlemen, you have 3 minutes each at this stage. I am going to jump around that panel. Mahesh, I'm coming to you right now, sir. In terms of risk premium and looking at the fact that you are going to also innovative instruments, you spoke about them earlier, your time, sir.
Thank you very much. The issue of risk is pretty critical to investors. They look at the question of whether they get fair return for the risk. And when there is market inefficiency, where premium is too high, the markets go to arbitrage that away. It is, many banks around the world are out there trading securities that are overpriced and underpriced. So if we feel very strongly that we are paying too much premium, let us create a mechanism to make it possible to drive that premium down, create an index of the premium that people can trade and see in the markets, and then see that they can make more money by going to where the premiums are. And that will attract more money and drive the premiums down. I was involved in creating the first CDO in 1988, 89. That took the junk bond markets in the US, where the premiums were very high, and actually there was not even market access, and made it possible to have access for more people by securitizing the junk bonds into CDOs, collateralized bond obligations and collateralized debt obligations. I know they then hit some market problems in 2008, but they were from the asset-backed securities market, not from the high-yield bond market or the high-yield loan market. So there are mechanisms that can be addressing the market inefficiencies that we think we have in African premiums by creating mechanisms to a market itself cure the premiums by creating an index.
I like that. We are building solutions, creating an emerging market index. Governor Tutuba, you are up next, sir. 3 minutes.
Yeah, thank you very much. Of course, I join hands with my brother, the way he has said, and we have seen in the market. Of course, the issue of premium has been a challenge. Previously we used to get money at a very reasonable terms. Now we are also facing the same challenges. When now premiums goes up, of course, even the margin also is being affected based on the current market circumstances. Now we have seen some of the lenders, they can also accept it to rebrand the financing. And you have seen, especially if you go to ECA, there are some times where if you are not in a higher risk based on the modality or the level that you have been assessed to your country, then you can also get those money in good terms. So based on the premium, of course, sometimes it depends and on the structure of the financing arrangement. We used to have, for example, the gender bond, which was subscribed or oversubscribed by some lenders, because the way it was structured, it was targeting to some small and medium entrepreneurship businesses. So people were motivated. So sometimes it depends. We have also witnessed some activity projects, especially if you tied up with environmental sensitive initiatives. You'll find that you can also get some premiums can go low, and at that stage as well, even the margin can also go low. It depends on sometimes the way you structure your financing arrangement. But we have seen to some extent as well, if you are issuing, for example, a bond, which is aligned up with some social services activities, you can also complement to lower the premium. But it depends. For example, for Tanzania, since we have been rated at a B2 plus, then there is a level of margin where, as a country, if your debt sustainability is not at a very risky rate, then you'll get either premiums which will be to some extent affordable according to the level of the market. Thank you very much.
So from the beautiful country of Tanzania in East Africa, we go now to the West African Development Bank. Allah, you come in here.
Thank you, thank you. Let me take an example, because we are facing these issues of risk and risk premium. We finance on part of our assets, we finance roads. And today, financing roads, especially roads that will generate revenues through tolls, usually these projects are not charged with high risk premium. We can find some capital to finance this with decent risk premium. And that, by the way, is the reason why across our countries you would find a lot of projects with infrastructure, roads, airports, ports, and everything. Because there are some revenues that can be used partly to pay the cost of the capital which is allocated to finance these projects. However, at the same time, we also finance schools or hospitals. And we all know a school will not generate any revenues. And the issue we're facing today, we know that building schools is our future. It's critical, we have to do it. But a project of building school will be charged high capital and high risk premium. So one of the ways to do it for us is to use mutualization. To make it simple, to use part of the future revenues that would be generated in a project on the road, to use part of these revenues to secure the funding and the resources allocated to pay the capital for a school. And we would do that for one reason, because we all know that there is a unity, and the development of a country is only one way to do it, and we have to do everything at the same time. No way we would give the priority to the short-term issues, the road, and it's good to have the roads, because this is the free trade, the trade area needs the roads, and at the same time, we cannot sacrifice the future. This, in a nutshell, what I should do.
Nikita, we have the BRICS Summit looming in August. I think it kicks off 21st of August in South Africa. I think if we can bring in the Russian perspective right now as we talk about these innovative instruments, we talk about guarantees, we talk about solidarity as emerging markets. You mentioned earlier pulling away from the influence of the US dollar. Perhaps weigh in with that commentary.
Thank you. Yeah, I think BRICS financial instruments are underdeveloped. We obviously have the new development bank, which previously was called BRICS Bank, but we believe it's not deploying enough capital into supporting the projects in the countries that are forming BRICS. So the summit would be one of the opportunities to discuss that. And we believe BRICS countries have a lot of interest in Africa. So not only South Africa, but also the Sub-Saharan Africa. So I think that BRICS, through the instruments they have, and maybe even through, settlement currencies, funds, not only the new development bank, may bring a lot of new capital into Africa if it's channeled right. And coming back to the question of risk, just one comment. I think that the African institutes that are here in the continent, like Afreximbank, like African Development Bank, should focus more on the guarantee business rather than funding business. Because funding is available. The question is that the international market, whether we're talking about emerging markets or developed markets, they're still very much skeptical about African risk. But they are ready to fund directly, provided they have credit enhancements. So once we have the institutions focusing more on the credit enhancement, we can get the direct funding, and it will save a lot of costs to African borrowers.
I just want, first of all, Tarun to come in. Mahesh, then you can come in with a comment there. But Tarun, if you could take it from an India perspective, and we can build on, please, the theme that is being put forward there from a BRICS perspective, guarantees. I don't think we've focused enough on the importance of guarantees in this conversation. Tarun.
No, absolutely. On guarantees, I was looking at a report from the India-American Development Bank. which said that, although MDBs are funding about 45% of private sector resource mobilization, guarantees account for only about 5%. And that's a very small number. Now, at around the time that COVID hit, we were looking at another study by the Asian Development Bank, which said that the total gap in trade finance is about 1.7 trillion. And we saw Afreximbank had started a wonderful program on trade facilitation. IFC has got something great, the African Development Bank as well. But we said, no, as Exim Bank, we are only going to look at medium to long-term financing. And soon we changed. We said, no, we must try and do something here. The program started on a pilot basis last year. We've done over 100 transactions, covered over 300 million of trade transactions with multiple countries in Africa, across the north, south, east, and west. This year, we're looking to have the program go upwards of $1 billion. That shows that the risk perception, what's happening really is that when you look at the risk part of it, the number of RMAs that were there with banks has reduced dramatically because the perceived risk is very high. Again, to quote a study, Moody's did a study from 1983 to 2019, which showed that the total delinquencies on debt in Africa is amongst the lowest in the world. That shows that perceived risk is perhaps higher than the actual risk involved, whether it's trade finance or it's long-term investments going into markets. Now, when you look at, again, I made a point on the extractive industries. If you look at non-extractive sector, that's where investments are not flowing enough. And we need to look at making certain regulatory changes, looking at developing or building institution frameworks stronger. And IFC has done a study which says that if this goes well over the next 4 years, we could see an additional 20 billion of investments flowing just in sub-Saharan Africa through these small changes. So there's a lot that can be done if we get it right. I think the future is very great. I'll just quote a couple of examples. For instance, Kenya, we've supported a textile company that has now created jobs. It is exporting out. In Mozambique, we started supplying PV modules for solar, setting up solar generation. Today, we are seeing that Mozambique, with additional funding, has now started manufacturing their own PV modules in Mozambique. The last point is here in Ghana. We are looking at a multimodal transportation network because it reduces cost, it reduces freight, it increases our move towards green transportation. And that multimodal transport, that corridor, we are funding it from Tema to Akosambo. It goes up to Burkina Faso. That can be a game changer, particularly for landlocked countries, because you manufacture and then you export out at much lower cost than what it does.
And I think that is the issue, is we start looking at these tangible examples of change, then we can celebrate the traction that we are making as Africa. Solomon.
So it's interesting, the gentleman from Russia talked about the fact that DFIs should start to really shift from lending to guarantees. Those of you who were in the prior panel heard the Minister of Finance talk about their issuance into the Panda bond market. The African Development Bank is using its AAA balance sheet to provide a partial credit guarantee to help Egypt diversify its sources of funding. And we're able to do this, helping them get tenor extensions and also, of course, price savings. Okay, so yes, we're going to do that. But we've got to go beyond what we as MDBs can do and create African institutions to do the same. And this is part of the reason that we've partnered with, the Pitch Group, the Nigerian Sovereign Investment Authority, the Africa Finance Corporation, to create InfraCredit Nigeria. InfraCredit Nigeria has credit-wrapped infrastructure bonds in that market to the tune of about $500 million to date. Local currency. Okay, we're going to create one in East Africa. We're going to create another one in other markets until we really start to mobilize African capital into the productive sectors. So for us, we've never seen a bankable project that cannot find money. So that is the gap that we need to think about. We need to look at ways in which we can scale up project development, speed up project development, especially in green infrastructure. And this is also why we are working with partners. We call it Team Africa, Team Europe combined, and Team America to create the Alliance for Green Infrastructure in Africa, to actually speed up, scale up green infrastructure, which is where the gap is in Africa. Thank you.
Jeremy Awori, let's weigh in with a private sector voice here.
There are a few points that come to mind here. They were mentioned by the panelists. The reliance on outside funding to solve Africa's problems is a mindset shift that we need to move away from. We have a lot of local resources. The question is, are we deploying those local resources, and what more can we do to actually get those resources and guide them into the right investment? So what I call local direct investment needs to be a focus, and local currency, local direct investment. For people to invest, they need the confidence. We've talked about perception around the risks that are being taken. Governments need to create that confidence by creating marketplaces that people can rely on, rule of law, that people's business investments will be protected, and that they're doing what they need to do at a macro level to give us that confidence that we're not going to find a reduction in value of our investments over time. There's a point that was also made around savings. How do we push up our savings culture? Whether that's pension savings or just individual savings, which comes back down to banking penetration. If we can drive up banking penetration using digitalized services, then we get cheap funds in terms of current accounts or savings accounts that can be used by the banking system to lend into SME, into agriculture, among others. We need to get better information, in my mind, both at a macro level for external investors, but also at a micro level. How do banks and other financial institutions use information to make credit decisions and rely less notionally on security, as I mentioned before? And then also working with various partners, what instruments can we use and develop that will attract capital? So we've got many millions of Africans in the diaspora who are saying, I want to invest in Africa, but where do I put it? So normally they go and they build a house or they invest in their relative's business, but can we pool together investment opportunities where people can come and say, I'll take my dollars and I'll invest there. It's transparent, it's professionally managed, and create an ecosystem of investment opportunities. But that will obviously push us to have to then drive up governance to give that confidence. And that's something at EcoBank we're quite keen on working with various partners, because this is not something where we're competing with each other. We have to work together to build these capital markets, whether it's multilaterals, bilaterals, DFIs, banks, other financial institutions, because we've got great talent, we have got great people, we have got great resources. Let's create the instruments that will give them confidence to invest in our continent and countries. Thank you.
Create instruments that will give investors confidence to invest in our continent. Kayore, Bank of Industry.
Sorry, get it.
Thank you very much. Talking of risk perception in Africa, it's very real. For instance, you pick the case of Nigeria. The rating agencies we've spoken about, they quickly downgraded Nigeria from B2 to B2 minus to CAA, and what that means is that the cost of raising money for Nigeria has just gone through the roof. Now, if you were to ask the rating agencies, why do you think the rating for Nigeria is the right rating? They will tell you very quickly that the debt profile is very high, that Nigeria spends a lot of money on subsidy. There are multiple exchange rates in Nigeria. Okay, no problem. We have a president who has come in. He has removed subsidy. He has aligned the multiple exchange rates. So we asked them, so why have you not upgraded Nigeria? Say, we are watching it. And the same thing happens in a lot of places, that the cost of raising money in Africa is very high. But like some of my colleagues here have said, you need to be creative and use guarantees and find means by which you can reduce your cost of raising money. Last year, in spite of the rating of Nigeria, Bank of Industry was in the market 2 times last year. February last year, we went to the bond market. We raised 750 million euros. It was very successful before the market went further north. In August of last year, we were also in the market and we raised €1 billion. Now, the point is, if Bank of Industry went to the market to raise money, if Nigeria had been downgraded to CAA and we are a sub-sovereign, it means we are going to raise money at the rate Nigeria will raise the money plus X, because the sovereign is supposed to be, a better borrower. But we couldn't raise money at those rates, as a DFI. So what we did was to make use of some of the instruments that we had discussed here. We went to the market, spoke to AFDB, spoke to AFC. Now AFDB has a triple A rating. AFC has an A3 rating. So we were able to get a wraparound, with AFC, and that reduced our cost of raising money substantially. So it was successful, and the rate was actually much lower than even Nigeria itself could have raised money. So the thing is that the guarantees are available. If you know what to do, if you are creative, the funding is available for Africa. But then you need to package it well. You need to have good projects. Like Solomon said, there are very few well-packaged African projects.
And I think that's a brilliant point to take it through to Dennis. There are very few well-packaged African assets. Do you agree, Dennis, from an Afreximbank perspective?
Yes, I do agree. There are very few projects that are packaged, but working together collaboratively, we can actually make that happen. And we are starting to see that. We've worked with the AFC on the Bank of Industry transactions. We have worked with the AFDB on a number of transactions. So working together, we can make this thing happen. The risk perception is there. To give you an example, on a standalone basis, Afreximbank is rated A by Fitch. It's public knowledge. But because we operate in Africa, they notch us 3 levels down because of the perception of their risk on the continent. And my view is, where does that perception come from? It comes from lack of knowledge. They don't understand the constituent countries on the continent. You remember when Ebola broke out in West Africa, they were issuing advisories in Cape Town. It's just, they don't know. Our engagement with the rating agency resulted in them reducing those 3 notches to 2, because we're now educating them about the reality on the continent. In terms of packaging, we actually have now established a separate department called Guarantees and Specialized Funding to really focus on this issue of guarantees. We provide our clients with guarantees to enable them to win contracts in support of African contractors. Because if you look historically, most of the major contracts were given to foreigners because even our own governments did not trust the capacity of the local entrepreneurs. So we're stepping in, providing those guarantees to enable them to win those contracts and finance them to import the equipment to execute those contracts. The dam in Tanzania was executed by Egyptian contractors because we provided the insurance that they required, and it's working well. So we are supporting that across Africa. I spoke earlier on about the Project Preparatory Fund. Even the insurance arrangement, the day before yesterday, we launched Afrexsure to ensure that we de-risk these projects and make them bankable.
Christian, I remind everybody of the topic at hand. We're looking at innovative instruments. We're looking at guarantees. We're also packaging that with Africa and the risk premium, whether it is perception or reality. Christian.
Yes, Bradley. As you know, there was a conference this week in Paris on this new pact on financing development, and this very issue of guarantees and how to bring the private sector in will be addressed during that discussion. The issue has to be addressed in line with the way we can bring the private sector to indeed finance sectors that are in line with the agenda of transforming economies in Africa. And for that, one of the things that the private sector is asking is for de-risking tools. So we need to find and to work more on this window of providing guarantees. At AFD, we try to do this in three ways. First, by supporting directly some African institutions. For instance, we have invested heavily with our friends from African Development Bank in Africa Guarantee Fund, for instance. That is a key player in this very sector. The second thing is what Solomon mentioned, to try to work on the platform of actors in Team Europe, going to look for the grant that Europe has in order to allow us, with our loans, to be able to de-risk some operation. And the last venue that we are using within AFD is to work on public payment guarantees for governments in order to allow the financing of key infrastructure that are done under private-public approach.
Thank you. Right. So, gentlemen, you have all done incredibly well. We have another 7 minutes. So I'm going to give you 30 seconds each to give me your key takeaway from this discussion, Unlocking Capital for Prosperity. Mahesh, I know you wanted to come in earlier, so I'm going to start with you. In terms of your final takeaway, you have 30 seconds each.
Thank
Mahesh.
you very much. Thank you very much. I would like to say that the initiatives on guarantees are the most important issue. They need to be scaled up. I worked for a guarantee company for a decade in the US, Monoline. Monoline's guaranteed $3 trillion of debt before they hit the skids in 2008. And they had guaranteed $30 billion in the emerging markets, more than all the multilateral development banks combined at that time. We need to scale up the guarantees that you do multiple times. Every development bank has to do that, and they're to be simpler, and they're to be Africa-wide. Country-by-country guarantee companies are fine, but you need diversification to scale up. That's
Solomon,
what we need.
Build on, scale up.
Capital is available, but we need to actually create the de-risking and the credit enhancement platforms. And I say platforms because we need to aggregate our resources as partners to be able to have a meaningful impact in terms of the project space in Africa. So capital is available, but it's not going to come easy. Let's figure out what we need to do in terms of guarantees and innovation to crowd that capital in. And let's also pay attention to our own African markets and our African sources, because that's captive to us. And if we get that right, the global flows will come on top.
Dennis. Just try it again, sir.
In 2014, we launched the Central Bank Deposit Program, where we're trying to get capital from the continent. We only raised 75 million. In 2022, we raised 8.6 billion from the African central banks and insurance companies and pension funds. So cumulatively, we've raised 33 billion US dollars over this period. So capital is available on the continent, but we've gone further. We're now looking at local currency funding, using our rating to access that capital and provide the tenors that are required for development. So working together with financial institutions such as the FDB, TDB, and even commercial banks like Standard Bank. EcoBank. Yes, we absolutely can marshal the capital that is required for Africa's development.
Allah, I'm going to jump to you. Governor, I haven't forgotten you. I'm going to take Allah first. Thank you.
Thank you. Allow me to give one more example about innovative instruments. 2.5 years ago, West African Development Bank has issued one of the first ESG bonds. The good thing is, instead of paying 5% plus on the senior debt, we issued on this ESG bond, we paid 2.75%. So a huge economy, which of course will benefit to our populations. The way to do it was to commit that we would use the proceeds exclusively to SDG-related projects. Of course, what is sad is that the non-SDG-related projects were typically excluded from these resources. Fine. But on the other hand, with this ESG bond, we have been able to secure the financing of key projects for our future. So that's just one thing I wanted to mention. Thank you.
Governor.
Thank you very much. I believe that all projects which can be implemented in Africa actually can have access to capital. What is needed is just to brand them in an appropriate way that will attract the capital. And as we have seen, there are a number of initiatives. If you brand it in a line which can be aligned with climate, it means you can access some discount from various windows which are provided like ECF, GF, Adaptation Fund, and the like. As well, if you put it, if it can be developed in sensitive to gender, as well as we did in Tanzania, we had a gender bond. So there are a number of ways. What is needed is to just be structured in an appropriate way and find a way that can attract financiers to lend on that project. But I believe all the projects can access capital from various ways. Thank you very much.
Kayode, 30 seconds each. We are counting down to that clock. We have exactly 2 minutes left. Kayode.
Yeah, thank you very much. I would say we need to create African champions. You know, we are telling Afrexim 30 years and we are congratulating them. Can you imagine if we can double the size of Afrexim in about 2 or 3 years? And we can do it. We have the capital. You know, we should support people like banks like Afrexim, AFC, and the regional banks. You know, some of the monies we have overseas, let's bring them back home and double and triple the capacity of these banks. They will do more for Africa than the banks we are running after.
Christian.
Yes, in 2 words, I would say that this conversation could not have been more timely. When you look at the context we are in, where needs for financing development in Africa are very, very high, and at the same time, capital flow towards Africa is shrinking. If you look at ODA, for instance, it used to represent 4% of the GDP of sub-Saharan Africa back in 2006. Today, it's only 2.5%. So yes, there's a need to really think how to find resources internally to finance development. And I think that is really key. And I will just finish with one example of something we did here in Ghana, where we financed the Ghana Investment Infrastructure Fund set up by the government of Ghana. It's a sovereign fund, and it allows to finance infrastructure. So we plead for more.
Right, we're going to be 30 seconds over. Jeremy Owori, I want you up next, and then Tyrone, you come in. Jeremy.
So for me, it's about partnerships, like what has been said. When I sit with my EcoBank team, I think what's the purpose of being in 35 countries, having 35 million customers? We need to use this in a way that solves African problems and uplifts our continent. So partnering with the players on the stage, the players out there is going to be key. How do we address some of these problems like trade? We've talked about Africa Continental Free Trade, partnerships like PAPS we heard yesterday. We have a platform today in EcoBank that you can do real-time payments across the continent. Why aren't we using that to encourage small traders to be able to do this? I would also say, let's try new things. We shouldn't be afraid to fail. Let's try some new pilots. If they don't work, what do we learn? If we try new things, then how do we scale up? And I offer EcoBank and our infrastructure to scale. And by working together, I think we can make our own small difference.
And Tarun, the last 30 seconds to you, sir.
I couldn't agree more with Jeremy. De-risking requires us to look at building institutional capacity of banks and institutions across Africa. And I think the onus is upon all of us sitting here on stage. And the second is to look at how do we look at credit enhancing so that banks across Africa develop stronger relationships across banks in other geographies. And lastly, in terms of skilling, I think our focus should be on skilling as we go into productive sectors to not only create employment, but also employability. Thank you.
Right, ladies and gentlemen, that's us. Thank you very much. A huge round of applause for our panelists. And I just want to say that must be a record. We are at 61 minutes and 15 seconds for 10 delegates on stage. Of course, Nikita's no longer on stage with us. Congratulations, gentlemen. Thank you very much. Mark.
Thank you very much, gentlemen. If I could ask you to exit this way, down these stairs. Thank you for that panel. Now, Now, before we break for a coffee break, don't stand up when I say coffee break. We're going to have a few deal signings. As you know, and anyone that has been involved or been part of the Intra-Africa Trade Fair or an Afreximbank annual general meeting, yes, there's talk, there's ideas, but there's also action. And you witness action in many of the deals that are signed during these events. This is no exception. We've got 5 deals today to share with you, for you to be our witnesses to these deals. I know they need to move some of the furniture around because, as you know, when you have these sorts of deals, you need a table, you need the chairs, and you need some lawyers. And I think there are some lawyers around who will appear any minute now. So we're going to have 5. We're going to do 5 deals. I'm just going to wait. We need the witnesses to said deals, the parties to said deals, for said deals to appear. Here comes the table and the chairs. So what I require now for this deal, the first deal that I'm announcing this morning, I need Kanayo Awani of Afreximbank. Kanayo, are you in the house, please? Because you are representing Afreximbank. Kanayo Awani. Is Kanayo Awani here? Madame Awani, have you seen her? Is she here? Dennis Denya. Dennis, you may have to do the honors here because I don't think, so you may have to do the honors and represent Afreximbank. Dennis, our executive VP, will represent for this first one. And then I would like to call Sabelo Sivuyile Makungo, who is the managing director of DigiLoop. Can I see Makungo, Mr. Makungo? Yeah, okay, here she is. Ladies and gentlemen, a round of applause for Kanayo Awani. Excellent. So all I need is the managing director of DigiLoop. The managing director of DigiLoop is here as well. Round of applause. This is the first deal of the day. And it is an MOU between DigiLoop and Afreximbank. Before I tell you what the deal is, let me tell you a little bit about DigiLoop. It's a company registered in Mauritius that's focused on enhancement and monitoring of external and internally generated revenues for sovereign states, for countries. The company will operate by collating and analyzing big data from crucial economic sectors, including telecoms and financial services, with the aim of presenting actionable insights. Knowledge is power, right? Information that regulators can use to be effective decision makers and form their policies. So that's what DigiLoop does. It loops digital information. The purpose of this MOU is to provide a broad framework for the collaboration between Afreximbank and DigiLoop towards providing revenue origination, enhancement, and monitoring services, as well as bankability review. Whereas Afreximbank is represented by Mrs. Nayo Awani, Digiloop by Sabelo Makungo, and the signing has taken place. Congratulations to both parties on this MOU between Digiloop and Afreximbank. Now, Madame Kanayo Awani, you are needed for another signing here. Our Vice President of the Intra-Africa Trade Bank. Mrs. Awani will be joined by Floyd Haynes, who's the Chairman of New Haven Merchant Bank. So, Mr. Floyd Haynes, do we have you in the room? Mr. Floyd Haynes, the chairman, of New Haven Merchant Bank. If you could make yourself known for the signing of the MOU between New Haven Merchant Bank and Afreximbank. If you're here, raise your hand so I can see you. Is he here? So here we have an MOU between New Haven Merchant Bank and Afreximbank. It's a partnership that will work with the Guyanese private sector and the government to identify business opportunities and projects that will be profitable for investors and contribute to Guyanese growth and development. The investments will focus on economically sound businesses and projects that will create manufacturing, agricultural, technology transfer, and service of jobs for the people of Guyana. Now, until recently, Guyana's economic activity was based on extractive commodities that were exported for processing. Afreximbank in New Haven will help change the economy.